Investing in monthly dividend ETFs with high growth potential is an attractive investing strategy for those seeking both regular income and capital appreciation. By investing in monthly dividend ETFs with high growth potential, you can enjoy the dual benefits of consistent income and capital appreciation, setting the stage for a prosperous financial future. In this video, we'll explore the top 7 monthly dividend ETFs that offer the attractive combination of dividend income and capital appreciation. With that being said, let's dive right in. Number 1. Wisdom Tree. The Wisdom Tree US Small Cap Dividend Fund is an exchange-traded fund that aims to give investors access to small-cap stocks in the US that pay dividends. This means the fund includes smaller companies that regularly distribute part of their earnings to shareholders in the form of dividends. The fund is quite substantial, with over $1.8 billion in total assets. This large pool of assets helps provide stability and liquidity, making it easier for investors to buy and sell shares in this fund. An important aspect to consider when investing in any fund is its expense ratio, which is the cost of managing the fund. For the Wisdom Tree US Small Cap Dividend Fund, the expense ratio is 0.38%. This means that 0.38% of the fund's assets are used to cover operating expenses each year. Since 2023, the fund has delivered a return of 1.16% to its shareholders. This return reflects the fund's performance, including any gains from stock price increases and the dividends paid by the companies in the fund. One of the major holdings in this fund is EPR Properties, which makes up 0.98% of the fund's portfolio. EPR Properties is a company that focuses on properties used for entertainment, recreation, and education, such as movie theaters and amusement parks. Wisdom Tree has a high dividend yield of 7.46%. The historical trend suggests that Wisdom Tree US Small Cap Dividend Fund has a good chance of delivering strong returns to its investors over time. Number 2. JP Morgan Equity Premium Income ETF. The JP Morgan Equity Premium Income ETF, commonly known as the JEPI, is an attractive option for income-focused investors due to its impressive dividend yield and monthly payouts. JEPI offers a trailing yield of 7.65%, which is notably high compared with many other investment options. This fund has quickly become popular, amassing over $21 billion in assets since its launch in 2020. JEPI aims to reduce volatility and limit downside risks while providing consistent income. It accomplishes this by combining two strategies: selling options and investing in large US companies that pay dividends. The income generated from these option premiums and stock dividends is then distributed to investors every month. The fund is diversified, holding 116 different stocks. However, its top 10 holdings only account for 16.7% of total assets, indicating a balanced distribution. These holdings consist of large, stable US-based companies from defensive sectors, especially consumer staples. Notable companies in JEPI's top holdings include Coca-Cola, Pepsi, and Hershey, which are known for their reliable dividend payouts. With an expense ratio of 0.35%, JEPI is relatively cost-effective. The fund is well regarded on several metrics, earning a neutral ETF Smart score of 7 out of 10. Analysts also rate JEPI as a moderate buy, with an average stock price target of $61.36, implying a potential upside of 13.6%. Of the 2,000 analyst ratings, 63.2% are buy ratings, 32.6% are hold ratings, and only 4.2% are sell ratings. Given its strong yield, regular monthly income, and a portfolio of blue-chip defensive stocks, JEPI stands out as a promising option for those seeking steady income from their investments. Number 3. JP Morgan NASDAQ Equity Premium Income ETF. The JP Morgan NASDAQ Equity Premium Income ETF, commonly known as JEPQ, is similar to the JP Morgan Equity Premium Income ETF but focuses on stocks from the NASDAQ 100 index. Launched in 2022, following the success of JEPI, JEPQ aims to deliver substantial returns from the NASDAQ 100 with less volatility. Just like JEPI, which targets the S&P 500, JEPQ generates income by combining the sale of options and investments in large-cap US growth stocks. This strategy helps in delivering a steady monthly income stream from option premiums and stock dividends. JEPQ is less diversified than JEPI. While JEPI holds a wide array of stocks with no single stock representing more than 2% of the fund, JEPQ has 78 holdings, with its top 10 holdings making up over 53% of its assets. This concentration means that big portions of JEPQ are invested in major tech companies like Microsoft, Apple, Alphabet, Amazon, and Tesla. For instance, Microsoft and Apple alone make up 12.1% and 11.1% of JEPQ, respectively. Despite being more concentrated, JEPQ shares some similarities with JEPI, such as its expense ratio of 0.35%. It also offers attractive 12-month rolling dividend yield of 10.1% and a 30-day SEC yield of 9.56%, making it appealing to income-focused investors. JEPQ has a favorable ETF Smart score of 8 out of 10, indicating an outperform rating. On Wall Street, JEPQ holds a moderate buy consensus rating with an average stock price target of $50.46, suggesting an 18.6% upside potential from current prices. Out of 1,000 analyst ratings, 68.52% are buys, 27.65% are holds, and just 3.8% are sell ratings. If you're enjoying this video, hit that like button, subscribe, and turn on notifications for more valuable content. Number 4. Global X Super Dividend US ETF. Like JEPI and JEPQ, the Global X Super Dividend ETF with the ticker SDIV is another ETF that pays out dividends monthly. However, SDIV stands out with a higher dividend yield of 13.8%, which is more than JEPI or JEPQ. Despite this, SDIV is a smaller fund with $790 million in assets under management. SDIV has an expense ratio of 0.58%, which is higher than the expense ratios of JEPI and JEPQ. This means that it costs slightly more to invest in SDIV compared to the other two ETFs. What sets SDIV apart is its investment strategy. It focuses on 100 of the highest yielding stocks from around the world, giving it a more international approach. In fact, only 30% of the stocks in SDIV are based in the United States. The rest come from a variety of countries such as Brazil, Hong Kong, China, Great Britain, Australia, South Africa, and others. SDIV holds 106 different positions, with the top 10 holdings making up just 15.4% of its total assets. This diversification means that no single stock has too much influence on the overall performance of the ETF. SDIV's portfolio features everything from real estate investment trusts to midstream energy companies and shipping companies. This diversity means that SDIV's holdings can be more volatile compared to the relatively stable blue-chip stocks in JEPI and JEPQ. One noteworthy aspect of SDIV is its impressive track record for dividends. The fund has consistently paid out a dividend every month for the past 11 years. This reliability can be very appealing to investors looking for regular income. Number 5. Invesco SP 500. The Invesco SP 500 High Dividend Low Volatility ETF, commonly known as SPHD, is designed for investors looking for stocks that offer both high dividends and low price volatility. This means it focuses on companies that provide steady income through dividends and have more stable stock prices. SPHD invests 90% of its assets in the common stocks of companies that are part of the S&P 500 Low Volatility High Dividend Index. This index is made up of stocks from S&P 500 that are known for their high dividend yields and lower volatility, making them attractive to conservative investors who prefer steady returns with less risk. The fund is particularly concentrated in the consumer defense and utilities sectors. These sectors are generally known for being more stable and providing consistent dividends. Some of the notable companies included in SPHD's holdings are Iron Mountain Inc., Altria Group Inc., Exxon Mobil Corp., Vornado Realty Trust, and AT&T Inc. These companies are known for their reliable dividend payouts and relatively stable stock performance. As of mid-2022, SPHD had net assets totaling $4 billion. This gives an idea of the fund's size and the amount of money investors have put into it. The expense ratio of the fund is 0.3%. This cost is relatively low, making it an attractive option for long-term investors looking to keep their investment costs down. The dividend yield of SPHD over the past 12 months was 3.53%. SPHD was launched on October 18, 2012, which means it has been around for a decade, providing investors with a track record to review. Number 6. The SPDR Dow Jones. The Industrial Average ETF, also known as the DIA, might not offer the highest dividend yield, but it has features that appeal to investors looking for a mix of income and potential growth in their investment. Launched in January 1998, DIA is one of the oldest exchange-traded funds available today. It is unique in that it directly tracks the Dow Jones Industrial Average, the DJIA, one of the most well-known stock indexes. The DJIA includes 30 of the most established and financially sound companies, often referred to as blue-chip companies. The ETF's portfolio includes major companies like Goldman Sachs Group Inc., United Health Group Inc., Home Depot Inc., McDonald's, and Boeing Corporation. These companies are leaders in their respective industries and are known for their stability and strong performance. As of mid-2022, DIA had net assets of $29.4 billion, indicating a substantial size and popularity among investors. The fund has an expense ratio of 0.16%, which is relatively low, meaning that the cost of investing in this ETF is quite affordable. Over the past 12 months, the dividend yield of the fund was 1.79%, providing a steady income stream for investors. Since its inception on January 14, 1998, DIA has been a reliable option for those looking to invest in a diversified portfolio of top-tier companies. Its combination of potential capital appreciation and dividend income makes it an attractive choice for many investors who prefer a balanced approach to investing. Number 7. Amplify CPP Enhanced. The Amplify CPP Enhanced Dividend Income ETF, known by its ticker symbol DIVO, invests in companies within the S&P 500. However, it doesn't just rely on the regular income from these investments. Instead, it boosts its earnings through dividends and option premiums. The fund manager actively writes call options, which are financial contracts that give buyers the right to purchase stocks at a set price. This strategy helps to generate additional income for the fund. When we look at the fund's holdings, the top investment is an ETF consisting of other Amplify funds designed to generate short-term cash flow. The rest of the portfolio includes well-known, high-performing companies from the S&P 500, which are generally considered blue-chip stocks. Over the past 3 years, the performance of DIVO has been relatively low compared to the broader S&P 500. This is partly because many blue-chip companies in the portfolio are currently undervalued, but are expected to improve later in the year. Despite this, the fund still offers a strong dividend yield of over 4%, which is quite attractive to income-focused investors. Additionally, the price of the DIVO ETF has increased every year, contributing to its reputation as a reliable and sustainable source of monthly dividends. This combination of a solid dividend yield and consistent price growth makes DIVO a compelling option for investors seeking steady income and long-term growth. As you consider adding these ETFs to your investment strategy, conduct thorough research and stay informed about market trends and economic conditions. Diversifying your holdings and aligning your investments with your financial goals and risk tolerance are key steps in maximizing the benefits of these high-growth monthly dividend ETFs. If you found this video helpful, please like and subscribe for more valuable content and financial insights. Thanks for watching.